Hello, everybody. I'll be today talking to you about one of the most important topics widely discussed, and now it is almost made a mandatory. I mean to say, internally, the corporates follow whenever they close the month end, whenever there is a month end books closure. In addition to the profit and loss account and the balance sheet, they also prepare a cash flow statement. So nowadays, it is found very imminent, and I mean to say, the importance of the cash flow statement. So let us discuss what is cash flow statement. Cash flow statement is nothing but a summary of the movement of cash. When I say a movement of cash, it could be generation, that is inflow, or it could be outflow. There is nothing but here could be your expenses or investment. Right. Okay. So now, under this cash flow statement, there are two methods. One is called direct method. The other one is called indirect method. So direct method is quite simple. That is nothing but you take up the opening cash balance and you add certain line items, add or subtract. What are those line items? They are nothing but the line items of operating activities, investing activities, and financing activities. So to arrive at a closing cash balance. Okay, so I'll explain you in some time from now what are these operating, investing, and financing activities, but this is the format that they follow under the direct method. Whereas under the indirect method, you take the net profit, you add or subtract the same thing, okay, that is operating, investing, and financing, and then you add back the opening cash balance, so to arrive at the closing cash balance. So now what is popularly followed is the indirect method. I'll explain you how. So today I'll be talking to you about the indirect method of preparing a cash flow statement. So what is the importance of this indirect method of cash flow statement? Is let us take, for example, the company has a profit of 50 lakhs, 50 lakhs, whereas the cash balance is only 2 lakhs. The company decides to pay 20% of dividend, that is nothing but 10 lakhs, but it has a shortage of cash to make so much amount of payment, that is 10 lakhs. So this necessitates for a preparation of the cash flow statement. Where is my cash going? The company makes sufficient profit, but it does not have a cash. That means it's definitely worrisome, and that too when there is a huge amount of the difference between the profit and cash, then definitely there needs a study, or we need to test it out as to why there is a difference of so much of amount between the profit and cash. Basically, this is a study between my profitability and liquidity. I'm going to study the difference between the profitability or liquidity, or you can call it as a reconciliation between my profitability and liquidity. So therefore, I'm going to reconcile net profit to my cash balance. So to understand where is the movement of cash under various heads, that is operating activity, investing activity, and financing activities. So all these cash movements under the operating, investing, and financing activities, when I add or subtract to my net profit, so that should definitely match to my cash balance. Okay, so this is the logic behind this indirect method of preparing the cash flow statement. And this is the purpose of why we prepare the cash flow statement, in order to understand, or reconcile, study the difference between the profitability and liquidity, that is 50 lakhs versus 2 lakhs, which I've given your example. So now, what is this cash flow statement? This cash flow statement is nothing but one of the financial analysis tools. There are so many other financial analysis tools which you would have already come across. That is nothing but your ratio analysis. It's also one of the very important financial analysis tool. There is also fund flow statement. There is also the common size balance sheet. Common size balance sheet, your comparative financial statement, trade percentages. So there are various, financial analysis tool, and this is one of the most important financial analysis tool because it is now mandatory to prepare a cash flow statement along with the financials from the ROC point of view when you are filing the annual returns. Okay, so now the other part which I was explaining, this is nothing but the activities, the operating activities, financial activities, and investing activities. So what is the difference between these three? As you know, the cash is nothing but, I would call it as the bloodline for the organization because the movement of cash is very, very important in order to meet the objectives of the business. So therefore, the operating activities nothing but, when I say there's cash movement, there is a cash movement in the P&L, right? Because of the line items that are affected by the P&L. So what are the line items? The income and expenses. Okay. There is also cash movement in the balance sheet. Maybe there is a cash inflow due to the capital, due to the loan. Also, there is a cash outflow due to the assets that I'm going to purchase as well as because of my investments that I'm going to do. So therefore, the net cash movement in the P&L and the net cash movement in the balance sheet is nothing but my closing cash balance. Of course, you can add the opening cash balance. My opening cash balance plus or minus the net cash movement in the P&L, because my inflow of cash is through the income and my outflow of cash is through the expenses. Plus, there is a cash inflow and cash outflow due to the liabilities and assets respectively. Add my opening balance, opening cash balance, that would naturally, it should reconcile to my closing cash balance, right? So operating activities here mean the P&L items. So what are the P&L items? It is nothing but my income and expenditures. So that is represented by current assets and current liabilities in the balance sheet. Okay, so the decrease in current asset and increase in current liability should be added to the net profit. So under this operating activities, you are going to consider only those items which are affected by income and expenditure. So the corresponding effect of the income and the expenditure you can see in current assets and current liabilities. So you're going to consider only these line items, and you're going to add the decrease in current asset and the increase in current liability to the net profit, and reduce increase in current asset and decrease in current liability. So now there is a need for understanding the logic. Why I need to reduce the current asset to my profit? We need to add the decrease in current asset to the profit and increase in current liability to my profit, and reduce the increase in current asset and decrease in current liabilities to the profit. So we will try to understand what is the logic behind this. I'll explain it in some time from now. So next one is the financial activities. Most of the students confuse between what is the difference between a financial activity and a investing activity. So the difference is quite simple. The financing activities is nothing but the cash generation. So where does the company's finance is funded from? From where? What is the source of finance? So what is the source of finance for the company? The source of finance for the company is capital. It's loan, maybe secured or unsecured. It could be debentures, maybe the partner's capital, the directors would have given the loan. So these are all the financial activities of the company. Of course, there is a cash outflow also in the financial activity, like you pay the dividend, okay, you pay interest on capital in case of proprietorship, and you repay the loan. So that is also cash. There can be a cash inflow and outflow in the financial activities, but it is restricted only to the source of finance. Okay, so that's financial activities. So now what is investing activities? Investing activities is the amount of investment the company makes. This is not the source of finance. It's not the fund where the company gets from, but this is mainly the company where the company is going to invest. So the company mainly it's going to invest in fixed assets, okay, and long-term investments, short-term investments, any advances that it has given, long-term advances that it has given to the directors or employees, okay, long-term advances, short-term advances. So all these are part of the investing activities because these are the line items that affects my basically cash. So what I'm trying to do here is from the net profit, I'm going to add or subtract the net movement of cash under various heads, that is operating activity, financial activities, and investing activities. So to arrive to my closing cash balance. Okay, so this will help me understand where is the cash inflow or outflow under these various heads. There can't be any other heads apart from these three. Operating activities, yes, it has covered the P&L items. The financial activities and investing activities takes care of the balance sheet. So the cash movement can only be in these two, that is P&L and balance sheet, nothing else, nowhere else. Okay, so this is what the format of the cash flow statement is under the indirect method. Okay, so now the main portion is what is the logic behind adding the decrease in current asset and increase in the current liabilities and increase in the current asset and current liabilities. So I'll try to explain this with example so that you understand the logic behind this. So first, let us take up the decrease in the current assets. Why am I adding the decrease in current asset? Okay, so let us take up a P&L and balance sheet. Okay, so move this P&L little this way. Okay, so the P&L income is 16 lakhs and expenditure is 10 lakhs. The profit is 6 lakhs. Okay, whereas the balance sheet, the sundry debtors, this is my previous year, this is my current year, previous year balance and current year balance. So sundry debtors, 10 lakhs previous year, 8 lakhs current year. Cash balance, 2 lakhs previous year and 10 lakhs current year. Capital, there is no change as compared to previous year. And then there is a profit. Last year profit was 2 lakhs. So now I have got 6 lakhs. So that's an accumulated profit of 8 lakhs. So the total is 12 lakhs, 18 lakhs, 12 and 18 lakhs. Okay. So now, so here my income is 16 lakhs and my debtors is 8 lakhs. So why we are adding up the decrease in debtors to my net profit? Decrease in debtors, it means the last year's debtors of 10 lakhs has been realized, right? That's why there is a decrease. So last year's 10 lakhs has been realized. That means it is converted into cash. Okay. As well as the current year income of 16 lakhs, out of that again 8 lakhs is further realized. So there is a cash inflow, there is more of a cash inflow, okay, as compared to the previous year. So when there is more of a cash inflow, you need to add back to the net profit. Whenever there is a lesser cash inflow, you're going to reduce it from the net profit. Okay, so now let us test this. So the net profit is 6 lakhs. I'm going to add the decrease in current asset. The decrease in current asset is nothing but sundry debtors. It is down by 2 lakhs, right? So the total is 8 lakhs. This will not match to my cash balance. So naturally, I should consider the opening balance of cash, that is 2 lakhs, where now you can see this will match to my closing cash balance. When I say is cash, it is cash and cash equivalents. So what is a cash equivalent? Cash equivalent is nothing but it consists of the banks, the balance in banks, that is various current accounts that you would follow, and immediately realizable liquid amount. So let's say you have made a very short-term investment that are readily convertible into cash. So that is cash and cash equivalent. Sometimes the company also has a foreign currency in hand, some balance in the travel, the cards that is given to the company, to the employees. So that would also form part of the cash and cash equivalents. So here, so from the net profit, so my net profit was 6 lakhs, but my cash is 8 to 10 lakhs. So I'm trying to reconcile between the profit and cash. My profit is lesser and cash is more for reason that there is a net decrease in the sundry debtors. The net decrease in sundry debtors, it means nothing but there is a net inflow of cash by additional 2 lakhs. So additional 2 lakhs is so that is how so that will you add up the opening cash balance, and that will naturally match to your closing cash balance. Okay, so that is the reason why I'm going to add the decrease in current assets. So I'll just repeat it again. So the decrease in sundry debtors is nothing but the net inflow of 2 lakhs more. When there is the reduction of debtors is nothing but the cash inflow is more by 2 lakhs. So this 2 lakhs, when I add it up to the profit, so I'll get my closing cash balance. Of course, I need to add the opening cash. I need to consider the opening cash balance also. So this is why we are going to add the decrease in current assets. So now let us take up the increase in current liabilities and see the effect. This, this is my profit. So my P&L is 20 lakhs. Income, expenses is 14 lakhs. Again, there is a profit of 6 lakhs. So the last year's numbers were capital 10 lakhs and profit 8 lakhs, correct? Right? 2 plus 6 was the last year's profit, accumulated profit. And this year, the capital, there is no change. Profit is 14. So there is an element of liability because we're working out on increase in current liability. So increase in current liability, we are working out on this part. So sundry debtors, opening balance was nil. and this time it is 8 lakhs. So sundry debtors 8 lakhs. There is no change in debtors, and cash balance, opening balance was 10. This time it is 24. So the total is 18, 32, 18, and 32. Okay. So now let us see the impact. So my expenditure is 14, whereas my central debtors outstanding is 8 lakhs here, which means the profit, for arriving at a profit of 6 lakhs, I have considered the complete 14 lakhs here. Whereas the cash outflow is not 14 lakhs, but it is only 6 lakhs. So that is, expenses is 14, but this outstanding is 8, which means what I paid is only 6 lakhs, right? So out of 14 lakhs, I have paid only 6 lakhs, and therefore my outstanding is 8 lakhs, which means the cash has not gone outside. The cash has not actually gone outside. So this is, the P&L is an accrual P&L. It is not a cash-based P&L. Irrespective whether I pay or not, I book the expenditure. Irrespective whether I receive or not, I book the income. Right? So this is accrual concept. So from this accrual concept, what I'm trying to do is the accrued profit. This is not a cash profit. Of course, these two are accrued items. The profit is also accrued item. So this, from the accrued profit, I'm now arriving at an actual cash. So in order to do that, what I'm going to do is, the net profit is 6 lakhs. I'm going to add increase in current liability. What does increase in current liability mean? Increase in current liability means that there is no cash outflow. When there is no cash outflow, naturally the cash balance will drop. So this is creditors. So as compared to the previous year, there is a increase by 8 lakhs. So the total is 14 lakhs. Add back the opening balance of 10 lakhs. So you get closing cash balance of 24 lakhs, which is matching to my cash balance. Okay, so this is the logic behind why we add the reduced current assets and increase, if there is an increase in current liability, we are supposed to add this to the net profit. Okay, so now let us take up this one. How increase in current asset needs to be reduced from net profit. So here the opening cash balance, that is opening the balance sheet items, is 10, 14, and 8. So let us change for the current year. And here let us keep the same thing. It is 8 and last year's it was 24. Right? So current year numbers will change on income and expense as well as profit will also change for this year. So my income is 23 lakhs. Okay, and my expense is 12 lakhs. So profit is 11 lakhs. Okay, so for the current year, my balance sheet capital, there is no change in the capital. So my current year profit is 11. 11 plus 14 is 25 lakhs. That's my accumulated profit. Central debtors, there is a decline. So therefore, the total year is 32, right? And 25, 35, 41 year. So previous year, this is 32. And current year, my debtors balance is 20, and my cash balance is 21. So that is 41. Right? So now let us change these numbers. So I'm going to subtract it. Right? So let's I need to add the cash balance. Okay. So now there is an increase in the current asset. When I say there is an increase in the current asset, it means there is no cash inflow. The last year's 8 lakhs, which was outstanding, has been realized, no doubt. But out of 23 lakhs of sale for this year, I have realized only 3 lakhs. The rest 20 lakhs is pending to be realized. Whereas the profit has gone up because I have considered the complete income. If I consider the complete income, my profit would naturally go up. So therefore, this is nothing but this is the accrued profit. That means it's a profit based on the accrual method. Okay, so this is accrued profit. So this accrued profit is not the actual cash. So in order to see the actual cash, I need to reduce this my the net increase in the sundry debtors. So net increase in the sundry debtors means the cash is actually not realized; it is parked in the sundry debtors. So to arrive at the actual cash balance, I need to reduce it from the profit because the profit consists of the complete income. It has considered the complete income here. So when I reduce it from the profit, I will arrive at the actual cash balance. So let us try this. So the net profit is 11 lakhs. Okay, I'm going to reduce the increase in current asset. Increase in current asset means there is no cash inflow because it is all parked in central debtors, and that is why there is an increase. So what is the increase in current asset? The increase in current asset is 12 lakhs, right? So since this is to be reduced, I'm putting it in brackets. So now the total is 12, 11 minus 12 is minus 1. If I add the opening balance of cash, opening balance of cash is 24. That will give me a closing balance of 23. So opening balance is not negative, opening balance is positive. So that will give me a 23, whereas my closing cash balance is only 21. 21. That means there is also another line item which you should observe, that is central creditors. So there is a decrease in the central creditors. When you say there is a decrease in the central creditors, that means there is a cash outflow. So decrease in central creditors means cash outflow, and increase in sundry debtors means the cash is not generated. The cash not generated as well as the cash outflow is one and the same category. So therefore, I'm going to say there is a decrease in current liability. Okay, this was sundry debtors. This is current liability, that is sundry debtors. So decrease by 2 lakhs. So here 12 plus 2 is 14 and 3 lakhs. So net cash movement is negative 3 lakhs, and I'm going to add the opening cash balance of 24. That will give me a closing cash balance of 25. So this will match to my closing cash balance. Okay. So increase in current asset, that means it is not generated a cash, and in decrease in sundry debtors, which means the cash, there's an outflow of cash which falls under the same category. So therefore I reduced it from the net profit so to arrive to reconcile to my closing cash balance. So this is why we reduce the increase in current asset. So now let us take up the last one, the decrease in current liabilities. We've already seen it. The decrease in current liability is nothing but which has to be reduced. Why we have to reduce? Because there is a cash inflow. But we can work out one more. We'll take up the simple one. So the expenses is the income is 40, expenses 25, profit is 15. So to replace this with the opening balance, that is 10, 25, and 6. Okay, so for the current year, 10 profit is 15 plus 25 is 40. There is no sundry creditors. Okay, so now the opening balance is 20 and 21, and the current year balances are 20. There is no change in sundry creditors, whereas cash balance is 30. Okay, so now net profit is 15 lakhs, as we know. Okay, and there is no increase in current asset because the debtors is same. So is there an increase in current liability? No, but there is a decrease in current liability. Right? Is there a decrease in current liability? Yes, there is a decrease in current liability. So whenever there is a decrease in current liability, I need to add this. So what is the amount of decrease? So decrease in current liability, that is under creditors, the amount is 6 lakhs. So that is 21 lakhs. And I'm going to add the opening cash balance of 21 lakhs. I'm sorry. So I need to reduce this, sorry. So that will give me 9 lakhs. And add the opening cash balance to match to my closing cash balance of 30 lakhs. So here, what has happened is there's no change in the current asset, whereas in the current liabilities, the sundry creditors are reduced by 6 lakhs. When you say the central creditors are reduced by 6 lakhs, it means there is a cash outflow. Whenever there is a cash outflow, you need to add it to the net profit. So to arrive at my closing value, you can see the expenses is 25 and everything is being paid off. Okay, whereas my income is 40 and 20 is still outstanding, it's same. So therefore, there is a net movement of cash outflow. The cash has been, as compared to the previous year, there is a 25 amount of expenses has been already paid off, as well as the previous year's outstanding is also paid off. Okay, so therefore, we need to reduce it from the net profit so to reconcile to my closing cash balance. So we'll take up one problem from the as far as the cash flow statement is concerned, and we'll work it out. So we'll get an actual picture of how the cash flow statement would look like. So I hope you have understood the logic behind why you are supposed to reduce the decrease in current asset and increase in current liability, and reduce increase in current asset and decrease in current liability for the net profit. Okay.